Hello, and welcome to this week's edition of Retire Well, the show designed to help you retire well in all aspects of your life. I'm your host, Kristen Oakley, and joining me in the studio is Kevin Bucher. He is the co-founder and a financial advisor at Citizen Advisory Group. Kevin, I know you've been so busy between the television show. I know you have live events in your area. I'm just excited to be back with you and getting to serve more folks today.
Yes, so we do have a series of live events that we do. So I'm one of three presenters that does the live events, and we have a variety of topics that we discuss. So we have a tax seminar that we do. We also just have general retirement planning seminars where we touch on a lot of the different areas that we talk about on the show.
Yes.
So we do have a busy schedule of events. You can always find those on our website at citizenadvisory.com. And we'd love to just kind of have people out, and we have a passion for teaching and educating people around these financial topics.
Absolutely, and looking at it from that comprehensive, holistic point of view, which is so critical. And for folks who might be newer to you, can you share a little bit about your office location and where they can find you?
Yeah, so we're in Perrysburg, Ohio, right off of State Route 25, on the opposite side of 475 from the Levis Commons shopping complex. So we have about a 5,000 square foot office, and I think we touched on another show that we're literally days away from breaking ground on an expansion that we're super excited about. It's going to allow us to bring some of our sister companies together with us because we do offer tax practice, a tax return, as well as a home and auto insurance agency. So we're going to be able to bring that all together under the same umbrella, and we're very excited about that.
I love that. It's all part of retiring well in every aspect of your life, right?
Yes, there's so much to it.
Absolutely. Well, we're going to be talking about a lot of those things today. You know, I think as I've traveled the country and worked as a financial educator, the number one cause of financial failure for a lot of folks is procrastination, putting things off. And I think, Kevin, you know, this area of financial planning can be very overwhelming for folks, especially if you're not an expert in it. But the good news is you don't need to be an expert in these things. You just need to be an expert in you, and then make sure you're connected to the right kind of expert, such as Kevin and the team at Citizen Advisory Group, who can really help you navigate all the different aspects of your financial life so that you can make sure that you retire well. And part of what makes this process tricky is there are so many unknown variables. There are so many things out there that we can't control. So let's start off today's conversation, because really what we're going to be talking about is engaging in proactive financial planning. We need to address the things that we can control and sometimes more importantly, the things that we can't control. So take it away.
Yeah, so we'll start with maybe some of the things that we can't control, because that seems to get more of the attention.
What we can't control,
yeah,
yes.
the things we can't control and have that much to do. So I think that leads people to maybe feeling helpless.
And powerless, right?
Yes.
Yeah.
And really our whole message is intended to empower individuals to participate in the process. But yeah, there are the noise out there distracts us from some of the personal financial planning work that needs to be done in these areas that we don't have the control over. Right. So the economy and the stock market would be the first one that I would kind of point out. And a lot of times I think people get confused and think of those two things as the same thing, but they actually are two very different things.
And they affect each other, but they are two very
Absolutely
different. So
affect each other.
talk about that a little bit.
Yeah, so you know, the economy, how is the job environment, what's happening in the interest rate environment, which is a big piece of what's driving the economy, inflation. So you have all those pressures in the economic environment, but what the stock market is doing, it's looking at that economic data, but it's forward looking. So it's trying to predict what this economic data is going to mean for the future.
Right.
So I think a lot of times we get hung up on what's happening in the economy today, not realizing that the market has largely priced a lot of that information in, and the market is trying to predict what's coming next.
Right.
And there certainly is some significant headwinds that we're facing economically that are affecting the market performance in 2022 into 2023. And we'll talk a little bit about that here. We get into the next segment. But those are a couple things that we really just unfortunately, we can't control the economy.
Right.
We can't control the stock market. Some other things we can't control is we can't control tax law.
Yes, legislative risk, as we call it within the industry, right?
Yeah, and I think there's three big areas to that. So it's tax, Social Security law, Medicare law, three huge things that affect retirees that, again, we don't have much control over that. As individuals, we get a vote. And so aside from that a vote, I don't think we get to control Social Security law change, tax law change, and Medicare law change.
Right.
But there's so many things that we can control. So I think if we can tune out some of the noise around these areas that we can't control and direct our focus to the things that we can control, we can really put ourselves in a better position for us individually.
Absolutely. So let's now talk about the things that we can control, because I don't know about you, Kevin, I'm a recovering control freak. I guess if you talk to my husband, I'm still a control freak. Kind of ironic. I ended up in an industry where there's lots of things you can't control, but there are some things that you can. So let's talk about that.
Yes. And I too have been accused from time to time of being a micromanager,
Yes.
But I try.
It's only because we care. We care.
Yes. So I think it's easiest to walk through the things we can control by kind of doing it by walking through the 5 retirement checkpoints. So there's 5 areas to the financial planning process. So I'll start just kind of work through these checkpoints.
Yes, let's go through each 5 briefly, and then I know we're going to go into more depth on some of them. Yeah.
So investment management is the first checkpoint. So yes, we can't control the market, but we can control how you are invested in the market and how much of your dollars are directly invested in the market. So we do have some control in that area. Can't control the market itself, but we can control our individual participation in the market. So the second area being retirement planning, that largely comes down to securing an income stream for yourself. And you do have control over how you set your finances up, and you can secure an income stream to meet your lifestyle or essential income needs and put yourself in a good position that way so that you have some protection against this volatility we see in the marketplace.
Right.
Third area would be the tax planning. Again, can't control tax law,
Right.
but we can understand the tax law, look at your individual situation, and try to mitigate or reduce what your individual long-term tax liability is. So taxes are something that, yes, we might be helpless in the rules, but we need to apply those rules to try to put ourselves in the most tax-friendly environment.
Absolutely. Create greater tax efficiency, if you will.
Yes,
Yep.
long term.
Yeah.
And sometimes that might mean actually paying a little bit more tax today so that we are paying less in taxes over the long haul.
Right, which is really counterintuitive, but it's so important to know.
Yes. Fourth area would be the risk management package. So making sure that we have proper coverage, across health, life, long-term care, home and auto, so that we have the right coverage in place so that we've protected ourselves. We have control over that.
Yeah.
And we also have some control over the cost of that. So we have to be diligent shoppers for our insurance. Right coverage is important, but we also have to make sure we're getting that coverage at the most affordable price possible. So risk management is something we have some control over. And then fifth and final area or checkpoint is the legacy and estate planning.
Yes.
Making sure that I have adequately protected my family in the event from legal things should I have a long-term health issue and I can't act on my own accord anymore.
Right.
So that's medical directives, making sure I have a proper will, maybe a trust.
Beneficiaries are up to date.
Yes.
That's so important as well. Yeah.
Yes. Sorry, I almost skipped that one, right?
No, but I think a lot of people think, oh, I have a will, I'm fine. But then you find out their beneficiary designations haven't been updated and those trump the will.
Yeah. And the point of all that is you have control over setting your financial house up.
Yes.
So yes, there's plenty of things that we cannot directly control, but there's so much opportunity for our personal financial decisions to put ourselves in the best position for the long term.
Absolutely. I really appreciate that you've set up these 5 checkpoints, because this is really the meat and potatoes, if you will, of what it means to have a comprehensive, holistic financial plan. We say this on the show all the time, but how you make a decision in one area of your financial life does and will affect all of the others. So this is why you can't look at anything in an isolated context. You have to look at all these different pieces and then fit them together.
Yeah, so we do a lot of what we call retirement checkpoint reviews, and it is essentially just walking through each of these 5 areas. And, it's typical that there's going to be priority areas.
Right.
And it is difficult to kind of handle all 5 areas in one fell swoop, just because there's so much to it.
Right.
But we need to consider all 5 areas as we're making the decisions.
Absolutely.
So yes, comprehensive financial planning across all 5 of those areas.
Right. Well, I know we're going to dive more deeply into the first area later in the show, the investment management portion. But before we do, I know you're also offering a complimentary tax report today. So would you mind sharing with the viewers a little bit more about what that is?
Yeah, so taxes, as we've mentioned, is one of those things that maybe we do have more control over than we think. Too often, the tax strategy is really just looking in the rearview mirror at the year that you just completed and not looking forward. So one of the things we provide is this tax report. The tax report is a snapshot of the most recent tax year. It's going to highlight for us maybe some areas that you missed as far as current year tax planning. But more importantly, it's going to provide some observations for us about things that we need to be looking at for the future that are potentially going to save us some tax dollars moving down the road.
Absolutely. Well, it's an important thing for folks to know, and I'm glad they're going to be able to get connected with you to get your very own complimentary tax report. So all you need to do is call that number on the bottom of your screen, 866-630-1675. You're also welcome to take out your smartphone. Simply open up that camera app. You can point it and scan at that QR code down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and a member of the team from Citizen Advisory Group will reach out to you and connect with you to schedule your time to come in and receive your complimentary tax report. When we come back, we're going to dive more deeply into investment management as we're talking about proactive financial planning. Do you know how you can reduce your exposure to investment losses and how you can control your costs and investment fees? Stay with us. We'll cover that when we come back.
For many people, they're on the hope plan and they're just hopeful that inflation isn't going to continue at a high rate, or they hope that their health's going to play out appropriately. And the reality is we don't know. But when we build a financial plan that kind of encompasses all of these areas,
Having an investment strategy that syncs up well with your retirement planning strategy, a tax strategy, risk management strategies, and then legacy and estate planning.
it just allows people to be free and go live.
Whether you have someone that's helping you with your investments and maybe a totally different person that's helping you with your taxes and insurance, you have a disjointed plan. And when you have a disjointed plan, there's cracks in the plan.
And we have experts in each of these different areas. And when you're doing it together in a cohesive plan, you stop money slipping through the cracks.
We recognize that a successful retirement really has to go beyond just the financial services work we do.
But we also have developed what we call Retire Well, which is our wellness program for clients.
It has to include some social engagement and social connection.
And so we provide opportunities to get involved and get engaged in the community, whether that's an educational event or a walk at our wonderful Toledo Zoo.
We are a family business, and as we bring in new clients to our firm, they become part of our family. So family is big to us, and we treat our clients as if they're part of that family.
Well, welcome back. You're watching Retire Well. I'm your host, Kristen Oakley, here with Kevin Bucher, co-founder and financial advisor at Citizen Advisory Group. Today's show is all about engaging in proactive financial planning. And specifically, Kevin, we're going to be diving into the investment management side of that process. I'm so grateful you shared the 5 key checkpoints that you walk through with folks as part of an overall comprehensive financial plan. We could be here for hours and even days, right?
Yes.
To unpack all of that. So today we're going to focus on the investment management side. And I think the question I want to start with, I know I've met a lot of people who are approaching, entering retirement. And obviously a shift happens from the accumulation years to the distribution years. A lot of people don't want to take that much risk with their investments anymore. And we're going to be talking about reducing your exposure to investment risk. But my first question is, do you find instances where folks can be too safe with their money and not taking on enough risk, if you will?
Yeah, so absolutely. 2022, partly now we're starting to see the markets pull back again in 2023. Mm-hmm. So that's a little unsettling for those that are entering into retirement or maybe just retired. Mm-hmm. But we still do need to have growth. So I kind of look at your retirement savings as your new employees, that you need those employees to still work for you.
Yes.
So we still need to have growth in our overall portfolio.
Your money needs to work for you now,
yes,
right?
You got to put your dollars to work. For one, they do have to outpace inflation.
Right.
So, inflation numbers have started to pull back some. But we still need to have a rate of return to keep up with inflation, or you're just losing purchasing power.
Absolutely.
Now, that is a little tricky in today's market to take on that risk, because the appetite for risk has maybe been tested for a lot of individuals here recently. A lot of the market movements over the past 2 years have been around the two I's, inflation and interest rates.
Yep.
And even though we've seen inflation start to come down a little bit, we're still seeing the Federal Reserve have a fairly aggressive posture when it comes to their interest rates and in the move of interest rates. So there was a general thought that they were going to start to pull back some of the interest rate changes. The market liked that news, but it's been kind of clear here in the more recent readings in September that we're not through the interest rate hikes, that there's probably some additional interest rate hikes that are coming, and the market hasn't reacted very favorably to
Right.
that.
It goes back to what we were talking about. You can't control what the economy is doing and the market, and those two play off of each other.
Right. So how do we protect ourselves while still getting the growth that we need?
Right.
So when we look at how to put together the investment portfolio, a very critical part of that is understanding what are the goals and objectives of these investments and what is your tolerance for taking risk. And the way I like to frame that is, I think advisors are very skilled at trying to make people feel comfortable with taking risk. And I think we do that in certain ways, partly by talking about investments and their performance in percentage terms. Now, as a former high school math teacher, I realize that not everyone relates to percentages in the same way.
And percentage math is a very different kind of math, right?
Yes, especially when there's dollar signs in front of it, right? So, so I think it's really important that we think of the amount of risk that you're exposed to in the terms of real dollars.
Right.
So
That just makes it so much more real.
yes.
Yeah.
So a good example of that is a newer client that we brought on named Jill. And for Jill, the conversation we had was about how much risk she was comfortable with in her portfolio. So one of the things that we're able to do is do a portfolio analysis of the current investments and pull some data from a third party, Morningstar, who kind of gives us some data then about how would your portfolio respond should we see a pullback in the S&P 500 of, say, 25%? How would your current investments hold up in that environment?
Right.
And for Jill, it represented an 18% loss.
Oh, wow.
So if you think about that, S&P drops 25%. Her investments project, there's no guarantee to this, project to drop 18%. So my question to Jill was, would you be comfortable with an 18% loss? And she thought about it for a minute. She said, well, if the market was down 25 and I was down 18%, I suppose that I would be comfortable with that. So the next step in the conversation with Jill, though, was, okay, so Jill, you have roughly a $700,000 portfolio. So an 18% loss for you would represent a $126,000 drop in your portfolio. So are you comfortable with a $126,000 drop? Well, her reaction to that was an immediate different response.
Right.
So putting it from percentage loss to dollar loss
just makes it so much
very
more real.
different response for her. So we had to look for some alternative solutions. And the first part of that is, if you're not comfortable with a $126,000 loss, well, then we need to reposition some of these dollars out of accounts that are subject to market losses. And in some ways, the high interest rate environment that we're in has been very difficult for the stock market. But it has made some of these other options where we're out of the market much more attractive, because we can get a real rate of return now in some of the safe options. So for her, that conversation led to, okay, so how much of your money do you want to have in stock market accounts that are subject to these market losses? How much of your money then do we need to put in these principal protected accounts that are not subject to the market loss?
And again, that just really puts it into real world terms for folks to be able to figure out, okay, how do I navigate this complexity of investment management and reducing my losses?
Yes. So for her, and really for everyone, so we went through the menu. And I know we're kind of getting short on time, but the menu of options outside of the marketplace, well, it starts with your bank savings and checking. So safe, FDIC insured, still providing a fairly low rate of return. Right? Now, there are some high yielding accounts in the savings space we're starting to see, so those are starting to be more attractive. But we also could look at certificates of deposit, so still safe, guaranteed rate of return, FDIC insured. So those are starting to be viable options again. We also looked at the fixed annuity space, so guaranteed principal by the insurance company with a guaranteed rate of return. Fixed indexed annuities, guaranteed, still providing some participation in some market upside without the downside. So there was plenty of opportunity for her to get the rate of return that she was looking for while reducing the risk of $126,000.
Wow. And to your point, how you make decisions in all these areas eventually affects your tax liability as well, which is why I know you're offering that complimentary tax report today.
Yeah, again, one of the things we can control, a little bit of the taxes.
Right.
So the tax report is going to be a snapshot of your current tax. It's going to allow us to look forward, provide some observations of things that we might need to consider moving forward. Things like capital gain strategy, things like Roth conversion strategy, where you're putting your savings dollars. So comprehensive analysis of your current taxes, the goal being to mitigate your long-term tax liability, to try to reduce what that long-term tax scenario looks like.
Wonderful. Kevin, thank you so much. To our viewers at home, that number to call to get your own complimentary tax report from Kevin and the team at Citizen Advisory Group is there on the bottom of your screen. Simply call 866-630-1675, or you're welcome to scan that QR code down in the right-hand corner of your screen, and that will get you connected with the team that way as well. When we come back, we're going to be talking about another important aspect that you have control over, which is your investment fees. Do you even know how much you're paying in fees currently and what those fees are actually getting for you? Stay tuned. We'll cover that when we come back.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination rain on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to Retire Well with Kevin Bucher from Citizen Advisory Group. I'm your host, Kristen Oakley. We are talking today about engaging in proactive financial planning and specifically in the investment management portion of that planning process. Of course, there's so much that goes into it. And Kevin, before the break, you shared a wonderful story about your client, Jill, and that Morningstar report, when it put dollar signs to what she was at risk of losing in her investment portfolio, that just made all the difference. And I know you shared you were able to put some money then into the safer types of investments. What did you do with the rest of her money? How did you allocate that?
Yeah, so the interesting thing with this approach is once we had built adequate levels of protection into her investment allocation, that she was comfortable, it actually empowered her to actually invest the other dollars a little more aggressively. And that's not always the outcome, but in this particular instance, it allowed us to segment some dollars over into some principal protected from market loss accounts. We put a specific amount in there to give the protection she was looking for, part one, but part two of that, it's also, we put enough in there for her to draw the income she needed. So between her Social Security, she does have a pension, and the money we had allocated into that account, her income was now satisfied for her.
Right.
That made her freed up to invest the other money for more growth. And when we can invest for growth, you're likely going to get better returns over the long run.
Of course, keeping up with the pace of inflation, and that money is doing a very specific job for you at that point.
Yes. So how did we do that? Well, we still believe in a very diversified approach to the investments. So for us, we're going to look at a variety of asset classes and make sure we have proper exposure. I think everyone out there probably is familiar with diversification, but in the real world, unfortunately, we don't see portfolios that are really constructed with what I would call true diversification.
Because it's diversification of asset classes, not just having multiple stocks or multiple mutual funds, if you will.
Yeah, because I think that's a good one to use is mutual funds. Sometimes we see folks that come in and they might have 4 or 5 different mutual funds and feel like, yes, we're diversified. We have these 5 different mutual funds. But when you peel the hood back and you kind of look into that, you see that, oh, those 5 mutual funds, yes, they're different, but they're actually holding
All
largely the same
stocks,
investments.
right? Google, Apple, Tesla, like all the big ones, a lot of times folks find that to be the case.
Yes. So when we're talking about diversification, we're talking about true diversification across a wide variety of asset classes. So that would be U.S. equity broken into large companies, small companies, mid-sized companies, growth, value. So U.S. equities or U.S. stocks. We also then are going to include some international equities into the portfolio. So you got the developed, you've got the emerging markets, small, mid, much diversification across the international.
Right.
Then we go to the fixed income. Fixed income, again, U.S., international, many different types of fixed income. Those are the bonds.
Right.
So we utilize many different types of bonds. But then we also add into the mix some of the alternatives, which have been pretty attractive in this high inflationary period because we do maintain an allocation to things like gold and silver.
Precious metals, right?
Have held up very well in this high inflationary environment.
Absolutely. Yeah, so much goes into it, and understanding that being truly diversified is the key. It's so important. Well, the other thing is when folks come in and they have a lot of mutual funds, you might not even be aware of what kind of investment fees you are paying for all of those mutual funds. So talk to us a little bit about that, because that's another thing that can be controlled is your investment costs.
Yes, and I wish we had more time to get into this, but I talk too much, Kristen. So,
It's all good.
So yeah, I think a lot of people are very unaware of investment fees, and you really need to look at your fees in 2 categories. One is going to be, what is the cost for your advisor? And that could be a wide range of things. So there's some advisors that get paid commissions to buy and sell, and then there's some advisors like us who are held to the fiduciary standard, who are fee-based advisors. So there's the advisor cost, but then you also have to understand what is the cost of the funds or the investments that they're using. And sometimes that can be just as much as what the advisor costs are.
Absolutely.
So you have to look at the total of the cost, and everyone's situation is different, but we are very cost sensitive. And in a lot of situations, we are bringing costs down while providing the comprehensive solutions that we provide.
Absolutely. Such valuable information. I think we need to do a whole nother show on this subject. Why don't we do that next week? Until then, thanks for joining us, and we'll see you next time.